Hi and welcome to On the Record, your playbook for tapping India. Today we have a special guest. He is Spencer, co-founder of Commenda. Commenda helps businesses expand to multiple geographies like USA, Canada, UK and many more countries. Today we will look at if you are a founder based outside of US and if you are trying to expand your business to US, how can you go about it? Hey Spencer, welcome to the show. Thanks for taking out time to talk to us. So my question is, Spencer, if I am a founder who is based outside of US and if I am thinking of expanding my business to US, how should I go about it?
There's going to be a few different things to consider. I think maybe one of the most unusual things about the US for foreign business owners when they're thinking about setting up there is that each of the 50 states has their own corporate law and their own corporate systems. Obviously, there's ones you've probably heard of more. There's Delaware, Wyoming, Nevada, Texas.
Right.
That are more popular to register a business in. For the purpose of our audience, who I think is going to mostly be tech founders, I think we should focus on Delaware, which just tends to be the right option. It's what investors want. It has the best legal system for settling disputes. You might have recently heard the story about Elon Musk and his compensation package. That was actually an aberration that they would do something like that. It tends to be the most stable place to have a business and raise outside capital, and that's why it appeals to technology companies.
Is there any specific reason why Delaware is the most preferred choice?
Yeah, as I mentioned, the court system, the Delaware, the Chancery Court is very efficient. Obviously, markets like India, I know many people in our audience will be from India. It takes years to get through the legal system. In Delaware, it's very fast. It's what investors expect. I actually know I have a friend, was a friend of a friend. He was setting his company up in Wyoming. Well, because there's no corporate tax, we should set up there.
No corporate tax?
No corporate tax in Wyoming. However, there's no venture money in Wyoming either. They want you to go to Delaware.
How does it matter? But if it is a tax-free, it is like use money in itself.
Right, and you would think that, and there's all these reasons you would hope they would invest in Wyoming, and there's all these crypto companies that actually do set up there. They have this actually a DAO LLC model in Wyoming, but investors want a Delaware C Corp. Their investment contracts are set up for that. Their diligence teams know how to work with it. It just ends up being, there's kind of a network effect. It's hard, right? Like I still log into Facebook. It hasn't been interesting to look at Facebook for at least 5 years, but just everyone's there. In the same way, Delaware is just where everyone is, so you sort of have no choice. And that's why venture capitalists tend to prefer it.
So effectively, if I'm interested in raising any venture money, you are suggesting that Delaware could be a great choice because that's where most of the investors recommend you to set up. So if I am setting it up in any other jurisdiction, there could be a flipping involved, or how does it work? So suppose I didn't have intentions of raising money, and I incorporated in say Wyoming, and now I want to raise money. So how should I go about it?
Yeah, and there's going to be many ways that you could do that depending on the nature of your business. But if you're a tech startup from day one, and just because I don't want to complicate the message here, from day one, you should aim to be a Delaware C Corp if you're going to raise from US investors. If you set up a Wyoming entity, it's going to become a legal process that's going to be case by case. If you go Delaware from day one, you'll be set up to fundraise from day one.
The next question is, so what kind of entity I should set up? Like, should I set up a subsidiary there or a parent entity? Because I already run a business in my home country. So when I'm trying to move to US, what should I be looking at, a subsidiary or a parent?
Yeah, and this is going to depend on the goals for your entity. Again, if you're fundraising, it's typically going to have to be the parent. That's what investors would want. They're going to want the intellectual property sitting at that level. They're going to want the entire cap table sitting at that level. There are exceptions, but again, this is not the common case, and you should expect that your business is going to have that expectation. Typically, a subsidiary would be appropriate if it's for sales purposes or employment purposes, or maybe you have you're a fintech company and you have a partnership with a bank. Those would be the times you would set up a subsidiary. There's liability protection reasons why you might set up a subsidiary sometimes. But generally speaking, if it's for fundraising purposes, it's going to be the parent company. That's where you've heard of the Delaware flip. That typically is when that comes into play. Maybe I raised my first round from investors in Europe or India or Southeast Asia, and then I'm raising my next round from US investors.
So
they're going to want the parent
go
company
Yeah.
in the US.
So then how do I do that? Like, do I flip the company, or I have already raised some money in my home country and now I'm trying to raise more money from US. So how do you recommend to go about it?
Yeah, when it comes to flipping, first off, the word is kind of an oversimplification of the ground truth. It's not like it's not truly a flip. You're not just picking it up and moving it over here. There's a lot of money to be made for lawyers in the flip process. It's the kind of thing where, again, typically the reason you wait until you have a funding round is because a large chunk of that, I mean, like, we'll hear founders will spend anywhere from $5,000 to, I've heard, $50,000 on a Delaware flip.
Right.
But if you're raising a $5 million Series A, it stings, but it's fine.
Right. So basically, it's a complex process, is what you are saying.
Yes, and it's very case by case.
Case by case basis. So we need to talk to an expert before taking what is the right way of flipping, or what is the right way of structuring.
Yes, you should work with a lawyer who has U.S. expertise and expertise as well in your local market.
Got it.
A lot of the complexity will come from local investment regulations and capital controls in the home market. But anything beyond that is, again, would be violating my piece of advice here, which is to talk to a lawyer.
Right. How does the role of having my customer base plays in this decision making? So suppose if I have a global customer base, do you think US brings any specific advantages while I'm targeting a global customer base?
Yeah, I think this is one of the good reasons to do it. I think this can be overstated sometimes by smaller companies. If you're a pre-product market fit startup, I don't know if a US corporation is going to get you to PMF, probably won't. But there's a lot of benefits of it from a sales perspective. There does seem to be a trust factor. If I see a US address and a US entity name, the banking system in the US is very smooth. You can set up a bank account in a day. You can have a payment gateway that works in dozens of countries instantly. I think that's a real benefit. I think, again, a lot of the times you have to ask yourself, like, what's the practical reason I'm setting up this subsidiary? We tell people all the time, don't set up this subsidiary. You don't need it. Just take the funds into your Indian bank account or your UK bank account or whatever country it may be. But I do think there's cases, again, smoother financial system, the trust that comes with a US entity, and just the global interconnectivity of the US financial system because it is the global reserve currency. I do think it offers those benefits, but I do think they can be sometimes actually overstated. I think many businesses should focus on getting a product market fit and then maybe set up that subsidiary.
Great. And so once I've decided the geography and parent and subsidiary, whatever I want to set up, what type of company you would recommend? Like, should it be a C Corp or something else? Or how should I go about that?
This will be case specific. Again, if it's going to be a subsidiary, you're frequently going to see LLCs because of the pass-through taxation. There's limited benefit in having a shareholding structure in a subsidiary that's complex. Typically, it's going to be wholly owned by the foreign entity. Right. Cases where you might see an exception, we have customers that do joint ventures. So maybe we have one. It's a biotech firm in India. They set up a U.S. subsidiary. They had a U.S. entity that went in 50-50 with them. So in that case, you would do a C corporation for the shareholding benefit. And you can do that with an LLC, but if you're going to raise investment into that entity, again, it becomes beneficial. This was actually very famous, like China would force every foreign entity that went in to set up a joint venture with a local Chinese firm. Now, they were doing it for different reasons than maybe your typical joint venture. We don't have to go into that. That's probably a separate video. Right. But typically, a subsidiary would probably be an LLC. This is always, again, it's going to be case by case. But unless it's like a joint venture or something, you'll probably do an LLC.
If it's a parent, then what would be your recommendation?
Again, if it's a parent and you're fundraising, typically you would see a C Corp. Sometimes you'll have a parent subsidiary structure for legal liability reasons. let's say you're a fintech company, let's say you have a C Corp you raised money into in the US, and then you'll actually have a US subsidiary under that for, let's say, a banking partnership or something like that, because you just don't want the liability to be directly conferred onto the hold company. But again, anything beyond that is going to be, I think, talk to your lawyer, but these are some of the reasons you would see these structures, and you might hear, well, oh, we did an LLC, or oh, we did a C Corp.
So is there a specific reason investors don't put money in LLC? Well, why only C Corp? Like, what are those advantages?
Investors expect to purchase shares. It's how it works. There's sort of ways you can do investments into LLCs, but it's not like Shark Tank.
Practice.
It's not Shark Tank. I can't go sell this number of shares for this amount of money because there's no shares. There's an operating agreement. There's partners in the firm, but there's no cap table in an LLC.
Or no cap table concept.
Not in the way you would think of it as a tech founder.
So that brings me to my next question also, like if I also want to give an ESOP or stock options to various stakeholders, then C Corp becomes the normal choice.
Yes.
Cool. So can you also give us some more detailed insights into difference between, or what kind of compliance looks like for C Corp versus LLC? Is there a major difference that you see, or those are kind of similar?
So LLCs can be taxed as corporations or as individually held entities. There's some complexities there. I think we should focus on what's going to be most relevant to our audience. So
From a strategic perspective.
Yeah, so I think typically, obviously, you're going to be a corporation. And with that in mind, there's taxation at a few different levels. There's the state level taxation. There's the national taxation. There's some like municipal level taxation, but we'll kind of leave that aside for now. The big things you'll need to know, if you register in Delaware, we'll use Delaware. I think we should, because again, if you're watching this video, like Delaware C Corp is probably the right option for you. If you're a tech company raising funds in the US, you're going to want a Delaware C Corp. So let's use that. There's going to be a yearly Delaware franchise tax. You could think of this is like Delaware's subscription fee, right? Okay. We have this great place to have a business. All the VCs are here. The courts work great. We're going to charge you this amount of money every year. So that's one. And then two, you'll have your IRS filings. This is the Form 1120. That's the income tax return. If it's a foreign subsidiary or if it's a foreign held business, there might be a couple of additional forms you have to submit with that. If you've ever heard of these Form 5471, 5472, the audience would probably have at least come across these. The 5471 is if you have a foreign subsidiary of a US entity. A 5472 is if it's at least 25% foreign owned.
Got it.
So that's kind of the very high level at the national. There's a few FinCEN filings you have to do. This is the Financial Crimes Agency in the US. It seems like it gets more onerous every year with them. There's a lot of anti-terrorism and anti-drug cartel regulations to try and avoid US corporations being sources of funds there. Once you start selling in the US, there's also a few different regulations. Every state has, again, their own sales tax system. That's sort of complicated. There's this whole concept of sales tax nexus, but that's probably a video of its own.
Right. So tell me from an IPO perspective, so most of the time when founders do plan a startup, they do dream of getting listed at some point of time. Does a C Corp or an LLC make a difference here as well? Like, can I go up to IPO with a LLC?
It does.
Or a C Corp?
And as always, you just want a C Corp.
Right. Okay, so LLC cannot go up to IPO kind of thing.
It would be a C Corp, yeah.
Great. Okay, cool. So now we know that C Corp and probably Delaware is the best choice if I'm a tech co-founder. How do I go about setting up this thing, the company?
Yeah, setting up a company in the US is very straightforward. The process is that you're going to submit some information about directors in the company. You're going to set roles. There's going to be a president, treasurer, secretary, so on. You're going to identify the name of the company. It needs to be a unique name. And then you submit the documents to the state government. There's different, you actually can pay for expedited processing in the US. There's an option, I think you pay some thousands of dollars.
How much time it takes?
Yeah, you can actually pay thousands of dollars and get it done in an hour.
Oh, is it?
Yeah, so this is typically for merger and acquisition deals, like big corporate transactions. That's why they have that. But typically, it'll take a couple of days, maybe 1 to 3 days, depending on which option you choose, a couple $100. And then you'll get your certificate of incorporation from the state of Delaware that will have the date of incorporation and the name of your company. Once you have that, there's going to be a few other documents, bylaws, initial board resolution, things like that. And then the big one is the employer identification number. That comes from the IRS. This is your unique tax ID that you'll get from the federal government. This enables you to open a bank account.
Okay, so until I don't have a EIN, I will not be able to open a bank account.
No.
Okay, so what are the next steps after incorporation? What all things I should be looking at?
Yeah, typically the first thing you're going to want to do is set up a bank account, and you can move funds in and out of your company. Otherwise, it's kind of hard to do business.
Right.
After that, you're going to have to execute what's called a share purchase agreement. So what happens for a Delaware C Corp, again, and we'll keep using this as an example, is there's actually a number of shares that are authorized, but just because they're authorized, they haven't been issued yet.
Right.
So what happens is if you're a founder in the company, let's say there's 10 million shares and you own 50% of them. So you're going to have to actually purchase 5 million shares from the company. Typically, you'll do this at par value. So this is a very, very small, it's like a fraction of a penny. And you'll buy them, it can be as low as $50 for the 5 million shares. You purchase them, you have to wire funds from a personal bank account to the company account, and then you now own the shares. So that typically is going to be the next step. If it's a subsidiary company, there'll be a process of the foreign corporation sending funds to the bank account. But those are kind of the next two big steps. Once you have that, you own your company. You can move funds in and out of your company.
And I can start doing business, like I can hire.
Yeah, you can raise outside investment. You can sell to customers.
I can hire employees, everything. Okay. Is there any business licenses that is needed to operate in US, and what are those? Some of them, if you can highlight.
Yeah, markets like the UAE will have this concept of a business license. The US doesn't have a direct version of this. There's very specific industries where you might have to register with certain agencies or things like that.
But for a tech company, is there any specific licenses?
There's nothing like that.
A GST or a sales tax, as you mentioned, do we need for a tech company a SaaS business kind of a thing?
Okay, so we do have state registrations. It's not quite like a business license. I want to just sort of be clear about that. The state level registrations will be triggered by a couple of different things. If you hire an employee in a state, you have to register your business in that state and start remitting taxes there.
You mean one employee?
If you hire one employee.
So if I want to hire from all the 50 states, I need to be registered in all the 50 locations?
Yeah, and so what registered means is that you register with the state. Again, it'll be like an unemployment kind of insurance for that state.
It's a
you register your business
quick
there.
Process?
Yeah, it's a one-time fee. It's not always straightforward or quick. It's usually straightforward.
But the popular destinations like California and stuff like...
California can actually take quite a while, despite their larger state budget. And all the tech companies being there, they haven't quite figured out how to register your business as fast as Delaware.
Oh, that's surprising.
Yeah, California can take as long as, we've seen it take 4 weeks.
Wow.
To get that registration there.
And this is needed only if I am trying to hire an employee in that particular state.
If you're hiring
even
an employee,
if it is a remote work setup or an office setup, is there a difference? Like I hire someone who is going to work remotely for me from his home, or only if I have an office where he will come and work as an in-person or a hybrid setup, then I need this registration.
Broadly, while there may be exceptions, if you hire a full-time employee in a state, because of U.S. unemployment insurance and other certain HR regulations in the U.S., you'll have to register in that state just for compliance purposes.
And this is only for employees, not for contractors. If
Correct.
I'm hiring a contractor in California, I need not register.
Correct. Same concept as hiring someone in a foreign country, right? If you hire someone as a contractor, you can avoid dealing with a lot of the local regulations. Right. That's why obviously you have these EOR businesses such as yours that offer these services for local employment. In the US, if you employ someone locally, you will have to do certain compliance in that state. So that's one. Two is that maybe I don't have an employee. There's other ways you can achieve what's called economic nexus.
Okay.
This is the point at which I have to register in a state. So if I sell, let's say I'm a software company, let's say I sell one software license for $300 in the state of New York, I don't have to report sales tax on a monthly basis in the state of New York. But let's say I hit a certain minimum number of transactions or a certain number of sales in one state, and it's state to state and it varies, and what counts and doesn't count also varies, so this is very sort of complicated. Then I might have to register.
So how do you track? Like, so I'm a SaaS business and I have people all over the world. And many times I don't take their exact location, or I don't know if you are giving me your exact location.
Yeah.
So how do I go about filing taxes on this?
Well, hopefully you're at least getting a zip code. That's if you at least have a zip code, it's sort of salvageable. My selfish answer is that you should track it with us, with Commenda. The more tactical answer, general answer is, I would say you'll need to keep reasonably good books. You should use an invoicing system that's easy to manage. You should make sure you're collecting as much information on the location of your customers as you can. And then you need to have a good accountant or accounting service who can help you track that, because it can be very complicated. You will get fined tens of thousands of dollars in fines potentially. And I don't mean to scare anyone. Typically, if you have a sales tax compliance problem, you also have quite a bit of revenue. So it's kind of a nice headache. But I talk to founders all the time who will say, didn't even know I had to register in the state of New Jersey, let's say, and I found out when they sent us a fine.
So what's the best way of remaining compliant? Working with a reputed or a good quality service provider, or is there anything else? First of all, how do I know what is applicable on me? Is there a common source of information which gives us all this? Like, if I am doing this, I should be taking this registration or that registration?
Yeah, it's not something as a founder you should try to manage. I'll be quite clear about that. And again, if you have this problem, you have enough revenue to pay for either a person to manage it or a service. Typically this is something that you will want an accountant looking at. You'll probably also want some kind of a tool. There's a lot of legacy tools, like if you've heard of Avalara. Avalara manages this for a lot of US companies. As I mentioned, we handle this. There's all these different approaches. Stripe Tax even tries to handle this, and they can at least kind of let you know when it's becoming a problem, and then you can go find a solution. But no, you're going to want to have some expertise, whether it's outside or bring some expertise into your firm, depending on what your plans are.
Sure. What are the registrations? So one is from the employee side, and one is if I have some threshold sales in a specific geography, then some registrations are required, like VAT and all. What other registrations could be applicable for a tech company, like a SaaS company or an AI/ML company?
Yeah, and again, it depends on the type of services you're selling. So if you hire an employee, you have to register your business in that state. There's no way around that. Depending on my industry, it will depend on if my business activity counts towards Nexus. And this is, again, why you're going to want an expert. I don't know the exact figures off the top of my head. I would kind of say, maybe we'll provide a resource as like an attachment to this video if you want to read more about this. Like, for example, Virginia doesn't tax software towards sales tax, the sales tax nexus. Some states will tax B2B, but not B2C. Some states will tax B2B and B2C. This is all actually downstream of a relatively recent Supreme Court case, Wayfair versus South Dakota, where they kind of ruled on sort of how states can and can't tax software. And again, it gets to be quite complicated. This isn't even just a US issue. You're seeing countries like, I think Israel recently passed a rule on import tax on software. So if I'm like a foreign tech company selling to an Israeli firm, there's actually going to be like an import tax levied on that software, which of course is silly.
Right.
Import, when it came over the fiber optic cable, it didn't quite stop at the port, but it's
there.
Countries and states are getting more savvy and more sophisticated about how they tax software.
So what other state registrations or anything you would like to highlight, like that we should be looking at?
I think we've covered most of the important stuff at the state level.
So why don't you give me some insights about how the taxation structure is and how it works at a tactical level?
Yeah, so I'll walk through a typical year for a Delaware C Corp that's maybe cross-border or has some cross-border ownership or subsidiary or something. So at the beginning of the year, you're going to have your W-2, your 1099. The W-2 is for employees, 1099 for contractors. These are filings. Typically, they'll be handled by your payroll, your HR software. If you have an accountant that's running payroll, they'll make sure these are handled. This just covers the taxation around the employment in your company and any payments to contractors under 1099. So that's the beginning of the year. You get to March, you're going to have Delaware franchise tax. This is always March 1st. It doesn't move based on your financial year. Delaware just says March 1st it's due. There's a couple different ways to file it, and without getting too technical, this should typically, for an early stage company, come out to hundreds of dollars, not thousands of dollars. If you're getting some crazy result from the system, you actually go fill out information on the Delaware website. And if you're getting any like crazy $20,000 or $3,000 even from Delaware, you probably filled it out wrong. There's a bunch of good YouTube videos you can actually find if you just want to file it yourself. This one's actually easy enough. You could file it yourself. It requires a few small pieces of information on basically your bank account balance and your cap table at the end of the previous year. You go to the Delaware website, you fill it out. If you do it the correct way, it'll be about $450, although that's not an official, I'm not promising that, but generally that's the range it comes into, and it's a simple payment. So that's March. For companies on a typical financial year, so January to December financial year in the US, April 15th will be the big deadline you hear about. That's the US tax deadline. Your Form 1120 is going to be due. That's your income tax for your corporation. If you're a cross-border company, if you have a foreign subsidiary, you're going to have a Form 5471. If you have at least 25% foreign ownership of your C Corp, then you're also going to have to do 5472, which is for foreign-owned entities. The remaining filing...
And these are done at IRS level or Delaware level?
These are to the IRS. Okay. These are at the national level. The only remaining filings that are super important to know about as an early stage startup or tech company is you'll have some FinCEN reports around any foreign bank accounts or foreign stakeholders in
foreign
the
holdings.
Yeah, there's actually a new filing that they just announced recently. It's just gone into effect. The BOI filing, which is that you just have to provide some information on stakeholders in the business to the FinCEN.
So you mentioned that typical financial year is January to December. So do we have the luxury of choosing our own financial year?
Yes, you can, and there's some benefits and drawbacks to doing it, but a lot of Indian firms, for example, will like to set it up so it's April to March to line up with their Indian financial year. When you're filing for your EIN, your accountant can set that.
So what are those factors that should go into deciding what should be my typical financial year?
These will be very case by case. What I'll say is this is something that you and your kind of finance team should think about, or if you have an accountant you work with, you should speak with them about it. There's some pros and cons, but again, it's very case by case, and this always veers into I don't want to give advice that can be specific.
So what do you see majority businesses following international businesses?
A lot of Indian companies do April to March.
But that is the case when I am having a US subsidiary or when I am having a US parent?
Typically we'll see it either way.
Okay.
Especially, we see a lot of Indian firms where the finance, like the books are done through India. And I think we see that those firms in particular tend to appreciate having the April to March cycle because it lines everything up.
And then my tax deadlines changes?
Your federal tax deadlines change.
Okay.
It just shifts 3 months. So July 15th becomes...
Got it.
Yeah.
Got it. Great. So now let me ask you something around if I am raising money in US, how should I go about? Like I have received a term sheet from a investor. Now what are the next steps that I should be aware of?
Yeah, so if you've gotten this far, you'll obviously, your entity is going to be pretty set up. You'll probably have already given them some kind of financial statement, probably some basic corporate documents you might have already given them. But typically the way it will work is once there's a term sheet, as part of that term sheet or as like a sort of side, I don't want to say side letter, that means something specific, but some kind of side agreement, there'll be a set of diligence terms. This is the information that you're expected to give to the fund's legal team as part of the process. They'll usually give that to you up front. It's honestly, it can be the Wild West out there. I know it, like my firm, for example, we raised a funding round recently and we had an investor who offers us a term sheet and then sends us a diligence list, and we provided them everything on the diligence list that they had asked for. Then they came back to us and they said, well, we want these 3 additional things. And I mean, at that point, you actually, that's maybe unusual. You wouldn't always see that.
But typically what all goes into a due diligence, if you can give...
Yeah, so again, it'd be like basic corporate documents, They'll want to know that you have all of your housekeeping, the stuff we talked about earlier, bylaws, and that your board is correct and that your cap table is structured correctly and that all the share purchases have been done. Typically, they'll want to see that. If you have any subsidiaries, they might want to see the same for that. They'll want to see that the subsidiary is controlled by the parent company. They'll want to see that the intellectual property is sitting at the parent company level. That's a big one. That's the big stuff from like a legal due diligence perspective.
How about different agreements that we enter with partners?
Well, yeah, obviously, yeah. If there's any strategic agreements, like if you're a fintech and you have a banking partnership, they'll want to see that. If you're building like a nuclear fusion startup, they'll want to see your patents probably or something like that. But for a typical SaaS business, like what I mentioned, we'll mostly cover it. A founder agreement is something that I see quite a bit.
So what is the right time to execute a founder's agreement? Just before raising money, like when you receive that?
Probably not right before you're raising money. You would probably do it early on. I don't always see businesses do this. I think it's more common in India. I think.
What are the risks or pros and cons of not having or having a founder's agreement?
Well, I think the number one cause of startup failure is a co-founder breakup. We've been lucky. Me and my co-founder have a great relationship, but we've definitely seen that where one co-founder runs away with the intellectual property and claims, well, it's my intellectual property. And the founder agreement can sort of govern some of these things around how you would handle disputes and the role of the two founders in relation to the company.
How does you go about valuations and all? Like, can you give us some insights, like raising the money? What is that 409 evaluation and stuff like this?
Yeah, I thought you were saying valuations, like fundraising valuations. Like, you should get the highest one that you can actually back up because you don't want to raise a down round. But to answer your question, 409A valuation, you can think of this like in India, you have like a fair market valuation. It's similar to that. It's a process where like once you've issued shares to employees, you have to get it done once a year for tax purposes, just to assess the real value of the shares. There's a couple different ways to do this. Typically, you'll work with it with your accountant or with an outside accountant to get these done. They're pretty straightforward, especially for early stage companies, and they do add a significant cost to your compliance burden every year. I see them go for around $1,000, sometimes more, sometimes a little bit less. But if you're an early stage company, you're probably only spending $1,500 to $2,000 a year on your US taxation. This is why a lot of firms, especially in India, will delay offering ESOPs and things like that to their employees. We actually didn't officially issue ESOPs to our employees in India for over a year because we didn't set up the subsidiary in India and there was all these problems. But we are going to have to do a 409A evaluation this year for the first time because we have. But that's a whole other video into itself. Again, is how to issue ESOPs to a foreign subsidiary employee.
Cool. Any tips that you would like to give to fellow founders on what hygiene or what steps they can take to be due diligence ready so that they can close the whole investment from term sheet to money in the bank in the quickest possible manner?
The legal advice is to keep your documents in order, make sure you have everything, be proactive about getting the diligence sheet from an investor that you're working with. Maybe the more tactical advice is actually, it's really important as a founder that you sort of set the frame with an investor, if that makes sense. Again, I've seen investors try and push founders around in diligence. They'll ask them for things like an audit or give me all your bank transactions or things like that. And listen, ultimately it's case by case. If you have multiple bidders for your deal, you can push back on these things. And I think that's something founders should know. And again, not to make it not about compliance, but I see a lot of founders, especially in foreign countries outside the US where the investor cultures are newer and norms are still being set. I see founders get pushed around. Normal things in a diligence would be like your certificate of incorporation, audited financial statements from your not audited, the unaudited financial statements you get in the US that are basically audited. But
is audit mandatory in US?
It's not, which is why I'm realizing, I say audited financial statement, it's actually an unaudited financial statement, but more like your official financial statements that your company has produced for your tax returns. Typically, like, it's normal to ask for that, but it's important. It's important to know like what's normal in a diligence so that you know what's not normal. It's normal to ask for your financial statements. It's normal to ask for legal documents about your company, intellectual property, founder's agreement, things like that. But it is important for founders to know that, because I see a lot of what I would call bad behavior.
Right. So, Spencer, any other compliance? So, what's your best suggestion? Like, if I am floating a company in US, so should I keep a compliance calendar to keep track of various compliances that goes into it, or what's the best way to overall manage my compliances for the US company?
Yeah, I think the important thing to keep in mind when you're operating a US company is that it should be pretty simple. If your business is simple, your compliance is going to be simple. Everything we've talked about, sales tax only becomes an issue once you're doing quite a bit of revenue. Your corporate tax is going to be pretty straightforward to file unless you're doing a lot of transactions. There's no monthly filing that you have to do in most cases if you're a startup, not at the federal level. You're not going to have to do it for Delaware. And I think it's something to keep in mind. I see a lot of founders maybe spend too much money or not understand that it's not a massive new commitment to have a US entity from a compliance perspective.
So you've worked with multiple businesses across the globe. On a scale of 1 to 10, where would you rate the complexities of running compliances for the US startup?
It's a good question. I can rate it amongst the markets I'm familiar with, which skew towards business-friendly markets. 10 being easy, 1 being hard.
Yes.
Probably an 8. I'll say it's trending the wrong direction. A lot of these new financial regulations, anti-terrorism laws, anti-money laundering laws have made it harder. But if you compare it to running a business in India, it's laughably simple compared to running a private limited entity in India. Compared to setting up a business in Indonesia, it's like a joke how simple it is. Right. The fact that your paid up capital in the US is trivial capital, whereas in other countries, if you don't put a certain amount of paid up capital into the business, you're not going to be viewed as trustworthy, right? There's all these ways. It's just simple. It's a high trust economy, and I think that just shows in that you don't have to do a yearly audit. The government isn't making you do monthly or quarterly filings unless you're of a certain size. It's simple, and if you're a small business, I think that's why it's so compelling.
Is that also a reason why it attracts so much innovative entrepreneurs to US?
That's probably a whole other podcast. I don't know what the corporate law is, why we put a man on the moon, but I don't know, maybe somehow it's related.
So thanks so much. I think this was really insightful. But before we wind up, I would love to touch upon some of the exit options that is available to a startup, right? So I could look at mergers, acquisitions, or it could be a liquidation or broadly an IPO, whatever. So these are 4 broad routes of an exit. If you can give us some insights as to what's the complexity involved, how much time it takes in each of these scenarios.
Sure. Maybe we can start from bad to good. So we'll start with the case where you have to shut your company down. I think, again, this is another thing to my previous point about how much more simple it is to run a business in the US compared to a lot of countries. Shutting a business down in the US happens in a couple of months. 700,000 businesses in the US shut down every year.
Is it?
Well, yeah. It's millions get formed and nearly 1 million shut down every year. But it's a pretty straightforward process. I know in India, I think it takes a year plus.
No, it takes anywhere between 4 to 7 years to exit out of India.
It takes years to shut down an Indian entity. In the US, there's nothing like that. There's just a few filings you have to do and dissolve the business. It's pretty straightforward. It shouldn't cost you too much money. It would be very painful if it did cost you a lot of money.
Yeah, because I'm bankrupt.
Yeah, exactly. Exactly. I have no money. I've probably, it's not a good situation, but luckily it's relatively simple to do in the US.
How much time it takes broadly?
Just a few months. It'll depend on who's doing it for you and things like that, but it's not going to take years to shut down a US entity.
Awesome. How about what's the next one, merger or acquisition?
Yeah, we can take M&A. There's different types of M&A, and that'll typically affect how the deal is structured. For the case of a startup, obviously you've heard an acqui-hire. That tends to be pretty straightforward. It's not even it's honestly not even really getting acquired sometimes. It's Like they're
So
just
it's
giving
only
you some
the-
money. They're giving like a little signing bonus almost, right? It's
And
like
then
some
you file
cash.
for bankruptcy for the existing company, like in Acquihire. How
I think
does it work?
I've actually never been part of an acquihire.
Okay.
I'm hoping I never am part of an acquihire. Right. That's sort of considered like the most acceptable failure scenario for most startups is to be acquihired. But I think I think it usually ends up just being like a small amount of cash that's kind of like a signing bonus for really talented people. Because obviously if you started a company and got to the point where you're acquihired, you're like super talented and you probably like built a great product and just didn't quite find PMF or something like that. But so that's like one kind of the M&A. That's more straightforward, but that might be more relevant to the audience because, you know, maybe someday we'll all get acquihired, right? And we have to be ready. There's the more complicated M&A deals. I know for a fact, I actually, like my best friend from college is a corporate M&A lawyer. He works on these deals. They really vary. I mean, for a startup, it can be...
And that's also the majority cases. Like a lot of startups gets acquired, right? That's the whole beauty of Bay Area or US, you can say.
It can be very case by case, though. I mean, maybe you'll have stock, it'll be purchased with a combination of cash and stock, and that's a big like, sticking point usually. But there's a proper legal transaction. Like you're going to be negotiating terms, and it's there's no standard advice on this. And this is again something where you'll definitely want to get a good lawyer. Like it's one of those things where a cheap lawyer is actually the most expensive lawyer. You're probably going to want to get a good representation and make sure that you're positioning yourself well in an M&A.
Typically, how much time it takes a M&A? Give me I know it's a case-to-case basis.
Yeah.
But to put some timeline, say 1 month to a year kind of thing is a good target in a normal...
Definitely in between 1 month and 1 year.
Early to mid-sized companies, I'm saying, not a large, say, 20, 30 billion acquisitions, I'm not talking. Probably, say, under 100 million kind of a deal.
Yeah, I mean, again, and it's you're always hesitant to generalize because these things are so case by case, especially with the regulatory environment right now. The Federal Trade Commission's been... I mean, the Figma Adobe deal recently fell through, and
those are larger deals. That's what
I'm saying. But I mean, the environment is like that. I mean, but at a smaller level, I had some friends recently whose company got acquired. I think it took a few months. They got a combination of stock and cash, enough cash that maybe they could take a nice vacation before starting, and then they got enough stock that they're going to stay at the company until it vests, right? And I think that's the big thing usually, right? Is when you get acquired. The big term that I think gets negotiated is the vesting period, right? You want it to vest as fast as possible, your shares in the new company, so that you can, go, right? But obviously the company wants to keep you there because you're part of what they're acquiring. Cool. So, but it's very case by case. I think I listened to a podcast recently with someone who had run M&A for part of Google, and they were saying like there's all kinds of M&As. Sometimes you are just acquiring a team that's like an acquihire. Sometimes you're acquiring specific IP, sometimes you're acquiring data, a customer base. Like there's all these different things, and it's very case by case. And I think the terms of the deal and the timeline will reflect that.
Right. Well, that's pretty insightful, Spencer. Thanks a lot for spending time with us. To me, it was super duper insightful, and I'm pretty excited of expanding into US soon. Any marketing message you would love to give for any founder who's trying to expand to US?
Well, if you want to do it, I think Commenda is going to be the place to go because we set up businesses in 8 countries today. I'm not biased. We operate in Singapore, we operate in the UK, we operate in the UAE, the US, Canada, all these countries. I have no reason to tell you which market's the best one if it isn't. So come check us out. I think we're the best platform for global businesses.
Good. Well, absolutely. And if you are trying to expand to any of these geography, Commenda is a serious player. They have really nailed the whole process and the whole experience really well. So probably you can always look at considering them. Thanks, Spencer. It was lovely having you on the show. I hope this will actually help motivate a lot of upcoming founders to expand to US. And thanks so much for your time.
Thank you.
Take care. Bye.